2025 is shaping up to be a complex year for investors, but we're going to call it rational exuberance. While equity prices are indeed high, leverage is very low. And that means companies have less financial risk, and it actually uncovers that their underlying profitability is particularly strong. Now, in the fixed income market, tax cuts and tariffs may push up inflation, and that means yields up, price down. And credit spreads are very tight, offering not much compensation for corporate bond risk. If you're looking for income from equities, conventional approaches like REITs, MLPs, or monthly covered call strategies all have challenges. Enter iSpy, ProShares S&P 500 High Income ETF. Driven by a daily option strategy, it offers the opportunity for high income, equity returns over time, and can capture the returns that traditional monthly covered call strategies may sacrifice.
Here's our 3 key observations for the year ahead in equities. Supported by a resilient economy, improving corporate profits, and broadening market participation, we think the potential is high for the bull market to continue into 2025. Remember, the current bull market that began in October of 2022 is still relatively young and has thus far produced below average returns as compared to all bull markets dating back to 1949. 2, we think broadening participation from other market segments like mid and small cap dividend growth stocks will continue into 2025. And 3, we view the equity markets as a compelling opportunity to derive income that is not correlated with interest rates. Investors potentially can harvest high levels of income that can grow over time by deploying a covered call strategy that uses daily options with dividend growth stocks across the market cap spectrum.
There are 3 key areas in fixed income we're watching in 2025. First, the difference in yield between corporate bonds and treasury bonds or credit spreads have narrowed, especially for those lower-rated credits. While the underlying fundamentals could still be strong, there might be limited room for further price appreciation. Second, long-term interest rates have adjusted to high levels of inflation and rate volatility now that central banks are no longer engaged in large amounts of asset purchases known as quantitative easing. Looking ahead, new policies, such as those related to trade and immigration, could bring more inflation pressure, so risks of higher interest rates remain. Finally, we believe the Fed have strong reasons to maintain its easing bias. Previous rate hikes affected lower-income households and the real estate sector disproportionately, and the full effect is still playing through the system. That said, we may get a burst of economic optimism, which will stimulate growth and shift the path of rates higher.